Hello and welcome to Money Unshackled News. Today we bring you a special episode wrapping up the financial impact of the mad events of the last couple of weeks from the new Cold War with Putin's Russia. The headlines.
Europe springs to a war footing. Germany, who has taken a pacifist position for decades since its shame in World War II, has now scrapped all that in favour of building up its military once more. As sanctions bite, the Russian economy is taking an absolute thrashing, with their currency and banking system crippled. With Russia now on the brink of defaulting on its debts, the Kremlin tells the US to await response to economic war.
Russia's economic woes extend to the stock market, which has been closed since the 25th of February amid fears of a sell-off. Russian stocks are set to plummet when it reopens. Index managers MSCI and FTSE Russell are cutting Russian equities from widely tracked indexes, which will likely result in a loss for index investors as the securities get dumped at market lows. Elsewhere, the London Stock Exchange suspends trading of dozens of Russian stocks.
It's not just the big financial institutions taking this action. Western companies are purging themselves of Russian-linked projects. And finally, has ESG lost its way? ESG funds come under fire as their shunning of defence and energy companies has led to underinvestment in these defence-critical industries. There's been a lot happening in the last few weeks, so we've aggregated all the important money news to bring you the stuff that matters. Now, let's check it out. And by the way, we want to give a special shout out to commission-free trading platform Stake, who are sponsoring this video. Stake are the go-to investing app to buy and sell US stocks. There are thousands of stocks to choose from and they charge zero FX fees when you trade.
Instead, Stake converts your pounds into dollars when you deposit money, so you only incur FX fees once, rather than every time you trade, as you do on many other apps. Stake are giving away a free US stock worth up to $150 to everyone who signs up via our offer link, linked to in the video description below. On the 24th of February, the world watched in horror as Russia's armies, commanded by Vladimir Putin, smashed their way into Ukraine, shelling hospitals, nuclear power plants, and civilian apartment buildings with impunity. Expecting an easy ride, Putin was reportedly shocked by the level of unity shown by the Western alliance, whose individual policies towards Russia had been all over the place right up until the moment of invasion.
The old NATO alliance has been reborn from the ashes of indifference in the face of a nuclear-armed Russia who is now willing to invade its European neighbours. Germany, a member of NATO, suddenly finds its whole economy at the mercy of Moscow. According to Reuters, Russia supplies a third of Germany's gas, they also supply a third of Germany's crude oil and over half of Germany's coal. Some estimates suggest these figures could be even higher.
It's not just Germany at Russia's mercy either. The whole of the EU has stupidly gotten themselves into a position where it relies on Russia for 41% of its gas imports, 27% of its oil imports, and 47% of its coal imports. The EU plans to phase away from coal towards gas for environmental reasons, but when both fuels are supplied by the enemy, they're in a bit of a bind when it comes to energy security.
EU countries, including Germany, have said that they will shift away from reliance on Russian energy, but for Germany in particular, this is easier said than done. Germany have also announced they have raised their defence budget by a third to 2% of GDP going forwards, so there won't be such a pushover next time Russia threatens them. As an immediate action, Germany went even further than this and supplied €100 billion for military investments from its 2022 budget. Germany's entire defence budget by comparison was just €47 billion in 2021.
This last point about increasing military spending now extends to most countries in the West as a response to the war. Defence stocks have skyrocketed as a result, benefiting investors with the foresight to hedge against war. BAE, for instance, shot up 24% in the first week of the war, while Germany's Rheinmetall was up a whopping 60%.
Sanctions currently being imposed by Western governments on Russia, which have always been weak in the past, are actually having some jaw-dropping impacts in this conflict. Russia, a major G20 economy, has effectively been cancelled by most of the rest of the world. Sanctions range from the small, such as Disney pulling the release in Russia of a kids' movie, to the freezing of Russian businessmen's assets, to some truly brutal economic actions that stop just short of triggering World War III. The most damaging sanctions are as follows.
Western nations are preventing the Russian central bank from deploying its 630 billion euros of international reserves and have banned all transactions with the institution. Normally, central banks have sovereign immunity from sanctions, so to target it directly is an extraordinary act. Next, Western countries have stopped the sales of Russian bonds in their markets. The Russian state has, in effect, been banned from raising sovereign debt internationally. In retaliation, Russia is blocking interest payments to foreign investors who hold Russian government bonds and banning Russian firms from paying dividends to overseas shareholders.
Shares of Russian state-owned entities may no longer be listed on EU stock exchanges. Plus, Russian banks are being cut out of the SWIFT international payment system. This will effectively block Russian exports and imports, as Russia relies on this Western technology to facilitate payments.
The US and Canada have banned all Russian oil and energy, while the UK announced that it would phase out Russian oil by the end of the year. In response, Russia has said it may close its main gas pipeline to Germany if the West goes ahead with a ban on Russian oil. How did Germany get itself into this position? Finally, the UK and the EU have banned exports of technology to Russia, including semiconductors, computers, telecoms, and parts that could be used by their military.
One result of the sanctions is that the Russian currency, the ruble, is in danger of becoming a toilet paper currency, crashing over 30% against the US dollar in the days since the invasion. If you think inflation is bad in the UK, it's nothing compared to the impact that the sanctions are having on ordinary Russians. Interest rates have exploded to 20%, making mortgage payments simply unaffordable. The annual inflation rate in Russia has jumped to 10.4% and will surely skyrocket the longer that sanctions are in place.
Everyday pleasures have been removed too. McDonald's, Coca-Cola, Heineken, cigarette company Imperial Brands and Starbucks are amongst many Western companies to cease trading in Russia. This will surely have an impact on these companies' profits, and therefore their share prices, since Russia is a market of 144 million people.
One good economic consequence to come out of the conflict from Putin's perspective is the price of oil. Russian oil is called Urals oil, and while it normally moves in sync with the more well-known Brent crude, the war has caused the two oil prices to go their separate ways, though both are now at a 7-year high. If you have oil in your portfolio, congratulations. Brent crude oil has now risen 6-fold from around $20 per barrel in April 2020, when we were saying buy, buy, buy. As Urals oil is one of Russia's main exports, the price rise is a significant boost to their war effort, where it can still find countries willing or forced to do business with it, such as Germany.
The shock of the war has had a massive impact on the stock market too, with Russian stocks taking the biggest hit. The Moscow Exchange, Russia's equivalent of our London Stock Exchange, has been closed since the 25th of February amid fears of a sell-off.
Russian stocks have still plummeted despite the closure, as we see on other exchanges such as in London. The Dow Jones Russia GDR index, tracking the leading Russian depository receipts that trade on the London Stock Exchange, has collapsed by a shocking 97% year to date, wiping £430 billion of value from the stock market.
In ETF news, index providers MSCI and FTSE Russell have cut Russian stocks out of their emerging markets indexes, such as the highly popular MSCI Emerging Markets IMI index that we each invest in ourselves. MSCI now classes Russia in its standalone market indexes. Investors in ETFs and index funds that track emerging markets indexes will be forced to realise losses once investment managers are able to sell off any Russian holdings, given they'll likely be selling these stocks off at fire sale prices or even total write-offs.
When a stock drops out of an index or is forced to be removed, as in this case, what happens is that ETFs and index funds sell their holdings in those stocks and then spread the cash from the sale over the remaining stocks in the index. In the case of Russian stocks, the funds will be forced to realise a loss rather than leaving those stocks to hopefully recover, which they may well do eventually once the war is over.
If those stocks are added back to the emerging markets indexes in the future, which they may if Russia ever makes friends with the West again, they will be bought back at a likely higher future price. You as an investor are being forced to take the loss now and miss out on the possible post-war recovery.
Elsewhere, the London Stock Exchange has suspended the trading of dozens of Russian proxy stocks known as Global Depository Receipts, or GDRs. Depository receipts are a replica for a foreign stock so that a company can be traded on the London Stock Exchange without being listed there. Removing this functionality is another huge blow to Russian investments.
It's not just the big institutions taking this action. Companies are purging themselves of Russian-linked projects, with BP ditching their 20% stake in Kremlin-owned oil firm Rosneft, and Shell dumping $3 billion worth of joint ventures with Russian state energy firm Gazprom, and closing down its petrol stations in Russia.
Shell will also end its involvement in the Nord Stream 2 pipeline project, in which it holds a 10% stake worth $1 billion. Nord Stream 2, the company, has since gone bust, letting go of all of its staff. Shell still managed to cock up their public image though, despite these decisive actions. They continued to profit from buying cheap Russian oil for a couple of weeks following the invasion, eventually having to apologise and pledge to stop doing so amid fury from the British public.
ESG funds have come under fire since the war started for their negative impact on investment into the defence and energy industries. This chart shows how investor money has poured out of Europe's defence stocks as ESG funds have become mainstream. It's funny how war can wake people up to the issues that really matter. When faced with a Russia that's armed to the teeth and led by someone seemingly unhinged from reality, suddenly defence companies are shown to be crucial for deterring tyrants, rather than being a nasty remnant of colonialism.
And home-sourced fossil fuels are now being recognised as essential to our medium-term energy security, with the government's attitude towards fracking shifting significantly this week from "it's never happening" to "maybe we should do this." Just weeks ago, ESG fund managers were pressuring oil companies to stop developing domestic supplies of gas, even though our failure to develop our own supplies has increased our dependence on Russia. And they were demonising defence companies on the basis that making weapons was immoral. With banks and investors cutting ties with the industry, there has been less money sloshing around to spend on improving our national defence.
The UK government has now appealed to fund managers to support the UK's defence manufacturers on the basis that it actually is ethical to defend British citizens from Russian missiles. Yet that should hardly have been necessary.
While honourable in its intentions, ESG has lost its way. It's failed to recognise that a robust arms industry and energy independence are the best defences we have of democracy and freedom. Surely we should be happy to invest in the companies that develop the equipment and energy supplies that will deter Vladimir Putin from advancing any further west.
Question of the day: how do you think your portfolio has been impacted by Putin's war? Join the conversation in the comments below.
Thanks for watching! On this channel we talk a lot about personal finance, investing in all things money, and if you want to see more great content, please click the subscribe button below.
This is MoneyUnshackled.com. See you next time.